You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hey everyone, and welcome to the podcast. Today we're going to be talking a little about some nerdy stuff. So for those of you listening, I'm going to apologize in advance and say that there's going to be quite a few charts here. So I'm going to do my best to talk you through all of them. But if you get to the end and you feel like it would be better to see these charts rather than just listening to me jabber on, I would encourage you to go over to YouTube, watch the podcast, or I guess it would be vlogcast in that case, on YouTube instead. That way you can stop, pause, rewind, go back, kind of look at what I'm sharing. But again, I'm going to do my very, very best to do everything I can to talk you through the charts, tell you what I'm seeing, and make this as clear as humanly possible, even for those who are listening on iTunes and Spotify. Before we get started, as always, a few housekeeping items. If this is your first time listening or watching, thank you so much for joining us. I'm Adam Koos, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group in Columbus, Ohio, and you're listening to the soon-to-be renamed and rebranded Cash Podcast. While the name is going to change, you'll be the first still to get all these updates if you subscribe. So that link, that little rectangular button there, be sure to subscribe on YouTube. You can also follow us on Twitter as well as Instagram. I'm on Twitter at Adam Koos. Instagram, Adam D as in David, Koos is my handle on Instagram. And of course, if you'd like to schedule an intro call at the end of this presentation, or really anytime, to confidentially discuss your financial situation in more detail, or if you'd like to get a second opinion on your retirement plan and or investment portfolio, you can always just head over to our website at libertaswealth.com. Click on that button that says click here to get started in the bottom right-hand corner when it pops up, and answer a few questions, after which someone will reach out and get something set up on our calendar just to chit-chat. Last but not least, again, all links, visuals, charts, and other educational resources are always available on our website at libertaswealth.com. And again, this is going to be chart heavy, so be sure to check out YouTube if after listening it just not enough makes sense. So apologies in advance to the listeners today, but let's go ahead and get started. So quote of the day: I was in New York City last week for the Chartered Market Technicians Association 50th Anniversary Conference. So it's the CMT Association's 50th anniversary this year. It was really cool. We had an opportunity to spent a lot of time on the floor of the New York Stock Exchange, got pictures underneath the bell. It was a really, really enjoyable experience, and something that I thank the CMT for. One of my favorite conferences that I attend each and every year, and it's very, very, very tech heavy. You know, we're talking a lot about supply, demand, momentum, trend, volume, different types of indicators, portfolio models, strategies. And lots of different people have their different strategies that they believe in. Not everybody, believes in everybody else's strategies or indicators for that matter. I don't know how it happened, but I ended up having two conversations on Elliott wave theory over the course of different days, and I was there for 3 days. So Elliott wave is personally something I'm not a huge fan of, but if Elliott wave's your thing, then that's your thing. So you got to have your rules. You got to believe in them. You got to stick to them. And whenever you build your portfolio management strategy or your model, whatever the rules are that encompass that model, you have to stick with them. So if you have rules but you don't follow them, you don't have any rules. I believe that's another quote I had in a previous podcast. But anyway, quote of the day today: Jurrien Timmer. He was at, or it's Jurrien Timmer, I believe. He was at the conference speaking. He's the director of global macro for Fidelity. And he said at the conference, and I tweeted this right after he said it: if you wait for the fundamentals to tell you when the market has bottomed, you're probably going to be late. And what he's basically saying here is that if you're looking at price to earnings ratios and price to book ratios, if you're looking at comparing PE on a stock or group of stocks or a sector to the market, so if you're using fundamental analysis to determine when the market's bottomed, chances are by the time you figure out it's bottomed, a lot of time will have passed, and chances are you will have probably missed a lot of the upside on the way back up the hill. Because this is obviously, this was a technical analysis conference, and we as technicians believe in technicals. We believe that we believe in the irrefutable law of supply and demand, which basically means that if more people buy, or if there's more buying enthusiasm than there is selling enthusiasm in the market, then price must rise. If there is more selling enthusiasm than there is buying enthusiasm, then price must fall. In other words, if Apple has the best quarter they've ever had for selling Apple watches, but nobody buys the stock won't rise. That's just how it is. So that's what when we're talking about fundamentals versus technicals, it doesn't really matter how great the earnings were, or how wonderful the bottom line sales were, or what the total revenue was year over year. At the end of the day, it's all about the perception of that information. It's all about whether or not the investors who own the stock want to sell it, buy more, and of course, if people who don't own it want to buy it or short it for that matter. So again, using another example, we'll just say if use banking stock, because the banking industry is in the spotlight this quarter. But if J.P. Morgan has their highest number of deposits and highest volume of new assets they've ever accumulated in history over the course of one quarter, but when that news comes out, everybody starts selling the stock, the price is going to go down. The fundamentals really don't matter at the end of the day, when as opposed to just analyzing price, the trend of price. And then if you want to add in things like, again, I mentioned earlier, momentum, volume, and things of that nature, these are the kinds of things that I'm looking at. So what I wanted to do today was, because the market bottomed in October, and at least thus far has not bottomed again, we have not seen an equal or near bottom yet. We have not seen a lower low yet. What I wanted to do is I wanted to share with you one of my favorite, I shouldn't say favorite, it's one of my many indicators, but I guess you would say it was one of my favorite indicators, and it's very simple. I want to preface right up front that this indicator that I'm going to show you is not, under any circumstances, the end-all, be-all, meaning you should not use this indicator on its own to invest your money. When building a model portfolio strategy or a trading strategy or an investment strategy, in my opinion, it should really go without saying, you should never ever use one indicator, one light switch, and say, if this happens, then I'm doing this, and if that happens, then I'm doing that. You need to take the weight of the evidence, and there needs to be much evidence analyzed before you make big decisions in your portfolio, and whether that's in terms of when to buy, when to sell, or what to buy, for that matter. So the indicator that I want to show you today is something called, there's two moving averages, and it's just a crossover system. Crossover systems lag. I want to start with that right off the bat. There's no such thing as trend prediction. There's only trend following. The second thing I want to share is that when you look at these moving averages, we're looking at weekly charts. So I'm purposely pulling up weekly charts. They're a little bit slower than daily charts, but that's good if you're an intermediate term investor like I am. I'm not a short-term day trader. My time frame is not swing trading, which would be 2 to 3, call it 4 weeks. My time frame is also not 3 to 4 years. My time frame is more of the 6 to 12 month range, which would be considered intermediate term. So when I'm looking at an indicator with a weekly chart, that weekly time frame is good for me. And when I look at a couple moving averages, in this case, the blue one on your screen, or in other words, the faster one that moves up and down faster and smooths out price faster, is the 13-week moving average. And what it is it's the average movement of the investment on your screen over the course of the last 13 weeks. And then the red line, the red smoother line, and it's smoother because it's slower, is the 34-week moving average. So the blue line is 13 weeks, the average movement of the investment in question. We're looking at the S&P 500. And by the way, that's all we're going to be looking at today is the S&P 500, just to make this simple. But it's the S&P 500's 34-week and 13-week moving averages, and when those two moving averages cross below or above one another. You are looking at a candlestick chart. Now, I know that these things look messy, but they're really, really not that complicated. All a candlestick chart is, when you look at the body of the candle, you're looking at the open of the day and the close of the day. If it's an empty, hollow candle, so if it's white and hollow and empty, that means it opened at the low of that candle and closed high. Think empty, hollow, high. If it's dark, if it's solid, if it's black, think it's solid. It's filled with lead, let's just say. So it's heavy, meaning it opened at the top of the candle and it closed lower. In other words, at the bottom of the candle that day. If you look at any of these candles, some of them have wicks on them above or below, and all the wicks are the high of that day and the low of that day. So if you look at this candlestick right here in late, call it October, early November, this is back in 1957, by the way, you've got an open on the low end, it closed at the top, but it went as high as the top of the wick and it went as low as the bottom of that wick there. So that's how you read a candlestick chart. But we're not going to even focus on the candlestick charts today because what we're focused on is the moving averages. And again, the moving averages smooth out price so you don't have to worry about the jagged ups and downs and the crazy volatility that the market sometimes shows us. I've already gotten rid of some of the volatility here because I'm using weekly charts instead of daily charts. So each one of these candles is actually 1 week, not 1 day. So if it's a 4-day week, that's still a week. If it's a 5-day week, then obviously that's also 1 week. So I'll keep that in mind as well. So what we're looking at here, I'm analyzing a few things. What I want to see is every time the 13-week moving average crossed below the 34-week moving average, going back to 1950, by the way, that's when I started this. And I'm going to show you all of them. So every time, I want to see every time the 13-week moving average crossed below the 34-week, I want to know, first, what was the total approximate loss from top to bottom when that crossover occurred? Second of all, I want to know, I wanted to find out, does it, once it crosses back over to the positive side, in other words, once we have a bullish crossover, did it go back down again? That's the second thing. And then the third thing I wanted to see was, if it went down again, did it create a new lower low? Now, the reason I'm looking at these things is because right now we're in a stock market, and I'll show you, it's the last slide I'm going to show you. We're in a stock market right now where we've already seen the market go down as much as 27.6% from top to bottom. And this is all amongst a 13-week moving average crossing below the 34-week moving average. So the question right now is, now that we're seeing things improve, are we going to see another leg lower? Is it going to meet or exceed the low of October? And obviously we have no clue, but what we can do is we can look back at history. We can look at every time this has happened in the past and compare it to what's happening today, and at least get a good idea of statistically and historically what the probabilities might be, just using historical data. So in this example, let's just start walking forward here. This is 1956, 1957. We have the 13-week crosses below the 34-week moving average. We got a 14.5% drop, and then we see a positive crossover, which would normally indicate that we're in a new bull market and things are going better. And we got, call it blue skies ahead. But as you can see, it stops here and does not exceed this high, and then heads down again. So it goes down another 20.5% or so before finally bottoming. We get another positive crossover here, where the 13-week crosses above the 34-week in 1958, and we're back off to the races again. But the market peaked in summer of 1956, went down and bottomed right around February of 57, peaked out again in summer of 1957, and then ultimately bottomed in, it looks like sometime around, I'm going to call it late 1957, fourth quarter 1957, first quarter 1958. So kind of a shallow couple drops there, but a very long time period, a very frustrating time period. The next one we're going to look at is 1959 through 1961. This drop was really interesting. So we got crossovers here. We got a couple whipsaws, but it goes down 8.9%. Then the market comes back. Then it goes down again. And then it comes back. Then it goes down again. But all in all, when you look at the very beginning to the end of that, you can't even call it a bear market, because technically it didn't even go down 20%. And I know that we are not supposed to care about the 20% rule that Ned Davis kind of put in place. But at the end of the day, this was a time period where in summer of 1959, the market peaked. It did not bottom ultimately until November of 1960. So again, summer to, it looks like about 12, 13 months. And it ultimately went down 13.6% over that time period. And then we saw a positive crossover here in early 1961, and the market was off to the races. If we keep walking forward in time, we've got 1962. We've got a negative crossover, so 13-week moving average on the S&P 500 crosses below the 34-week. You've got this huge drop of 27.8% in a very short time period in 1962, late spring, early summer. And then it comes back, kind of bounces, pulls back just a bit, but we don't see another low. And then we get the positive crossover here of the 13 back above the 34, and we're off to the races. And that's 1962, 63. Now, if we work in the next one we can look at here is 1965. 1965, the market goes down 9.6% on a negative crossover here, but it comes right back and starts going back up again. We see all-time highs, but just a few months later, so after the crossover, which would occur in September of 1965, the very next, we'll look at April, I'll say. The very next April, we get another crossover to the downside, and the market heads lower again. This time from top to bottom goes down 22.3%. It bottoms in, looks like October of 1966, and then we get a positive crossover, and again, the market's off to the races once again. So the damage here was pretty shallow, down 9.6. It comes back, exceeds the prior high, then it heads down again, but the losses are a little bit steeper this time around. And by the way, we do get a lower low, so the market did take another leg lower. The difference between this time back in 1965 and what we're seeing today is that the first drop was only 9.6%. So if the drop's only 9.6%, and then we see another crossover, another negative crossover here of the 13 below the 34 week, and we see it down 22.3, I don't want to say that's not surprising because, of course, again, we can't predict, right? But what we can look at this and say, the first drop was only 9.6, so if it dropped again, would it be all that unusual to see it drop more? I guess what I'm saying is that if the first drop were 22.3, it would surprise me to see it drop more than 22.3 again. In fact, I would expect the next drop to be a little bit shallower, or at least close to the bottom previously met on the first drop. But in this case, it was different because we had a shallow drop and then a bigger drop. And again, that kind of makes sense to me, but it was a lower low, just different than what we are seeing today in the market. We look at the 1968, we got another, it's kind of similar situation. Market goes down January, we call it first quarter of 1968, goes down 10%. We get a negative crossover here, and all of a sudden the market heads back higher again to all-time highs. But then we get a negative crossover here in 1969, a full year later, by the way, and the market never quite kind of figures out how to get back up into a positive trend. It goes down 36% between, looks like the peak would have been in November, December of 1968, and then it bottoms in May, June-ish of 1970. So we're looking at, a full 18-month period of the market going down 36%. So we did exceed the low here, but I think one other thing I need to start mentioning is the importance and why it's important to pay attention and to kind of open up your eyes and wake up and smack yourself awake when we see the 13-week below the 34-week moving average. I would say that that's an important thing that we need to pay attention to. That doesn't mean sell everything, because as you can see here in 1968, if we would have sold, we'd be selling somewhere in the ballpark of, I'm going to draw my eyes to the side and say $91 a share on the S&P. And then if we bought the positive crossover, well, we're buying the positive crossover sitting here at about 98. So we technically paid higher prices. Now that's how trend following works, right? We can't always buy the bottom and buy the top. That takes a lot of luck and a lot of consistency. That it's kind of like golf, pretty hard to do. But here into the second crossover, we would have sold somewhere in the ballpark of about $99 per share on the S&P. And then when we bought back in, we would have bought back in somewhere in the ballpark, it looks like 84. So that ended up being a nice opportunity to get out, save some of our money, and then buy back in on the way back up the hill. But again, that's why you don't want to use just one indicator. You want to use the weight of the evidence. And in my boat, I believe in using a dimmer switch as opposed to an on-off switch, scaling in, scaling out. So the next one we're going to look at here, as we move forward in time, is 1971-72. We have this crossover that takes place in late 1971. The market goes down 13.8%. It's a pretty short-lived experience. We can say it peaked in May of 1971. It bottomed later that year in November, December, and then that was the end. It was pretty much right back to positive prices thereafter. If we look at the next one, now we're looking at 1973-74. This is the big bear market in the early 70s. Oil embargo. Looking at your license plate to determine whether or not it was your day to go get gas put in your car. And when we look at the peak of the market here, we've got a crossover in March, April-ish, call it first quarter of 1973. and then the market goes down. There's a very short time period. We're talking like a week where we got a positive crossover, but that was it, and it was right back to the negative again. But we're saying from March, April-ish of 1973 until I'm going to call it 18 months, 20 months later or so, in September, October of 1974, the market goes down 48.2%, or just call it 48% or so, and then we see a positive crossover. Market goes up. We do see a negative crossover again, but we do not see a lower low. In other words, this low up here is higher than this low. So while the market did consolidate a little bit and kind of pull back, the drop was a 14% drop that was very short-lived, and then the market was back up to recovery levels again. Next one is 1978. What we have here is the market peaking in 1977, January, and then from top to bottom, so from January of 1977 until spring of 1978, the market goes down 19.4%. So kind of just a very, very long, slow, grinding decline. Then we get a positive crossover here. The market goes up, but then it declines again on another negative crossover, but it's down this time 13.5%. We get a higher low, so we don't see another low. In other words, the low that was printed in spring of 1978 is never surpassed again, and then the market heads off to new highs. The next one here is 1980 and then 1982. In 1980, first quarter, market peaks and goes down very quickly in just a matter of 1, 2, 3, 4, 5, 6 weeks, 17%. So pretty big correction in a very short period of time, but then the recovery is also very fast. You know, there's a saying on Wall Street says the market takes the escalator up but the elevator down. So, you know, when that elevator takes place, like in this case, 1980 is a perfect example, it went down really, really fast and really swift. So you've got this recovery, positive crossover, and we're back off to the races again. But very shortly later, just a year and a half later, we get another negative crossover. S&P's 13-week moving average crosses below the 34-week, and we get a drop of 27.2% from the peak of November of 80 to the bottom, which looks like it was in, I'm going to call it August of 1982. So that's about, again, right around 18 months, something like that, maybe 20 months again. So 27.2% drop, but again, did not exceed the low from 1980. So if you draw your eyes all the way back, if you're looking at this chart, for those of you listening, the lows of the second drop, so the second drop that took place from late 1980 to mid-1982, the second low was actually higher than the low in 1980. So even though it was a bigger drop from a percentage standpoint, we still, first of all, did not exceed those lows. It was another pullback, obviously. Well, in this case, it was a bear market at a drop of 27%, but we did not exceed the low from 1980. And of course, if you were paying attention to the 13 over 34 week moving average and how it crossed over here, you probably could have saved yourself a lot of pain on the way down the hill. Next one we're looking at is pretty shallow, 1984. In 1984, the market peaked in late, call it fourth quarter of 1983, actually, and it bottomed in July, August of 1984. So it looks like about 1 year it took. The market went down 14.6%. Not a whole lot of volatility, to be honest. And what I mean by that is, for those of you listening, the candles are pretty close together. We're not seeing huge, gaps up and gaps down here. So this was a relatively orderly drop in the market, even though it took place over a very long period of time. It was pretty shallow at only 14.6%. That would be considered a typical, run-of-the-mill correction. From there, the market headed higher. 13-week moving average crosses above the 34-week. And again, we're off to the races. In this case, this indicator, green light means go. Next one's kind of a killer, 1986-87. For those of you that were in the market back in 1987, you may remember something that happened back in October of that year. But first, let's scan back to 1986. There was this drop, a moving average crossover here, where the 13-week crossed below the 34-week. Market went down 10.3%, very shallow drop as far as I'm concerned, and then the recovery was relatively fast. But we had Black Monday, And then when Black Monday took place, we have this huge drop from top to bottom. If you look at it on a weekly basis of 35, almost 36% from top to bottom in a very short period of time. If I count it out, the peak of the market on an intraday basis or intra-week basis, I'll say, would be, say, 1, 2, 3, 4, 5, 6, 7, 8, 9. Let's see, get that right? 1, 2, 3, 4, 5, 6, 7, 8, 9. That's it, 8 weeks. So yeah, 8 weeks from top to bottom on an intra-week basis, a drop of 36%. Now, believe it or not, 1987, the market was actually positive that year. I know many don't know that. But even though Black Monday obviously put a huge dent in portfolios and market cap that year, the market actually did end up positive, believe it or not. But the point of showing you this chart is the 13 over 34 week moving average would not have helped you here. And just like it would not have helped you during COVID. This is one of those outliers, anomalies, black swans, whatever you want to call them, where things just move too far, too fast, and there's not much you can do to save yourself. Aside from using other indicators. And that's where we get back to the weight of the evidence. We have to look at like what was going on back then. Did we see some things going bad in the market? Did it make sense for you to dial back exposure due to maybe some other indicators and clues that we're seeing in the market? So in this case, we did see a lower low on an intra-week basis and on a weekly closing basis as compared to the late 1986 low. And that's something that, we got to take into account when we look at the stats and we're comparing it to today. We fast forward to 1990, market goes down 1990 on an intra-week basis between late 89 and early 90, goes down 11.3%, 13-week moving average crosses below the 34-week, crosses back above again. We see an all-time high, but it very quickly falls right back again, going down 20%, just over 20%, and a lower low than the prior low. And again, I'm going to go back to saying what I did when we were talking about the 60s, and that is that while this did print a lower low, and a lot of people right now in the market, talking heads, analysts, a lot of doom and gloomers are saying that this market's going to head lower and we're going to have a recession and things are going to get much, much worse from here, and it's going to look like 2000, 2001, 2002. Could it? Yes, of course. Anything's possible. We live in a world of probabilities, not certainties, so anything is possible. But the probabilities, in my opinion, I don't believe that's the case, I guess. And when you look at this lower low here, it took place after a relatively shallow correction. So you see a drop in late 1989 to 1990 of 11.3%. No big deal. 11.3% is one of those things that gets recaptured quickly and you don't even notice it on your monthly statements. But here, that 11.3%, you compare that to what we've seen this past couple of years, a drop of 27.6 on an intraday basis. That's a much, much bigger drop. In fact, it's bigger than the second drop here. So while the market could go lower, when you have a drop that we've already had in our market, and I'll talk about this a little bit more when we get to today's slide, but when you have a drop that like the one we've already had, and when you look inside the market and you see the stocks within the stock market, and you look at the fact that many stocks peaked in February of 2021, which was more than 2 years ago, and have already started to bottom and head northward. Whether that you can look at some of them bottomed in late summer, some of them bottomed in October, some in December, but we're seeing more and more stocks heading northward. And while pessimism may not be at an all-time high, it's still pretty high. And when pessimism is high, that's a sentiment indicator. And sentiment just simply in the case of sentiment indicators, many times we're looking at the opposite. So if everybody's really, really negative, then that's actually a positive for the market, because once there's no more positive people, all that can happen is the market can start going up, right? And then same on the top side. If everybody's optimistic on the market, there's no one left to be negative. Eventually, the last bull jumps on the pile and the pile falls over. But I digress. I'm talking too much here. Let's move forward again to 1994. In 1994, the market went back. You can see how shallow this is. Market went down on a moving average crossover, 13 crosses below the 34-week. Market goes down 9.7% from top to bottom. It crosses back above it, but we get a very, very shallow crossover here that lasts, again, just a week or two. Another drop of 7.3%. But first of all, we never even saw a double-digit drop. Second of all, the low was actually higher than the prior low. So we did not see a lower low in the case of 1994. The market just headed higher from there. In fact, it ended up resulting in one of the biggest bull markets in U.S. history, if not the biggest. Moving forward in 1998, this was a pretty quick whipsaw in the market. 13-week moving average crosses below the 34-week after a pretty big drop. In 1, 2, 3, 4, 5, 6, 7 weeks is all. Market goes down 22.4% roughly on an intra-week basis, but it bounces, falls back again just a couple weeks later, and then it's off to the races again for the market. So a very short whipsaw here. Market comes right back, and there is no second crossover. There is no lower low. Just kind of a blip on the radar at the end of the day. Now, this one's a little different. We've got 2000, Y2K, .com bubble. We got a moving average crossover here, 13 crosses below the 34-week in October-ish, call it fourth quarter of 2000. The peak of the market was way back here, as you can see, so early 2000. And the market goes down 39.1%. We'll just call it 39% from top to bottom, but this is call it an intra-year bottom. And the reason I stopped here, I usually don't, but the reason I stopped here is because there's a pretty clear positive crossover in the 13-week, as you can see, if you're watching on YouTube, and that would essentially indicate that maybe it's time to get bullish again. If we're just using this indicator alone, which again you shouldn't, but that would be signs that maybe we got some green lights on the horizon. But it crosses right back below. It goes down another 34.7%. We'll just call it 35%, and the market bottoms before. And then when we get the next crossover, 34-week or 13-week crosses above the 34-week in second quarter of 2003, then we're off to the races at that point going forward. The next one is 2004. I got ahead of myself. In 2004, there's a very short crossover here. 13-week crosses below the 34-week in July, August, September of 2004. Market goes down 8.8%. That's it. From top to bottom, we're talking about spring of 04, and then it bottomed in third quarter of 04. So not even much to really talk about here, but it still was a crossover at the end of the day and a whipsaw to boot. Moving forward again, here's 2006. Again, a very shallow drop in the market, drops 8%. We get a moving average crossover here, positive crossover. Then the market's back up again. It's just heading up to what ended up being all-time highs before the mortgage crisis and the biggest drop, going back to the Depression anyway, in U.S. history, which would have been the mortgage crisis, 57, almost 58% decline. The 13-week moving average on the S&P crosses below the 34-week moving average at the end of 2007. The market declines, and we never see the 13-week above the 34-week again until summer of 2009. So that's a pretty brutal beating here, but we never saw a lower low. You can say that if this right here in November of 2008 was the low, which a lot of people thought it was, by the way, and a lot of people bought into that low, and then it headed lower and we saw another leg lower, then yes, that's definitely a lower low at the end of the day. However, it was a lower low all within the context of a 13-week moving average below the 34-week. If this were a daily chart, it would be a 50-day moving average below the 200-day. It's a negative sloping 34-week moving average is sloping down. The 13-week is sloping down. Only very briefly did we see it turn upward, and that's it. Twice, that's it. So you got to be really, really careful at times like this, and be cautious with your stock portfolio. Moving forward again, 2010 is where I thought I was earlier, down almost 17% on a crossover here. And then we see a positive crossover. 13-week goes above the 34-week. We get all-time highs. We do get another drop, another crossover, but again, this time it's higher lows, not lower lows, higher lows. So this, again, is not today's market. 17% is not 27% or 28%, whatever you want to call it. But that was more of a shallow drop than what we've seen this past couple of years. This was a bigger drop, obviously down 21.6. At that point, the bigger the drop, the higher the probability in my book that we probably don't see another drop, and that's exactly what happened. Things just kept heading higher from there. If we fast forward, and we're getting close to the end here, 2015-16, the double dip, You've got a 12.5% drop here in from May of 2015 when the market peaked. Pretty nasty whipsaw here. We get a crossover right there at the end of 2016, after which the market decides it's not coming back. It's going to head right back down again, goes down 14.5% or so before finally bottoming on a lower low. So we did get a lower low this time, but I repeat, just like I have in the past with all these other slides, that it was relatively shallow both times. Now, again, these whipsaws can really rip you to pieces, or cut you up, for lack of a better phrase. But once we saw that positive crossover on the second time, it was off to the races and the market was heading higher again. And then now would probably be a good time to say that it's not often that you see the market cross the 13-week moving average cross below the 34, above it, back below again, and above it a second time, only to head lower again. Usually once it's crossed above it a second time, that's the end. And we can be pretty confident in that signal. Second to last one here. We're almost at the end of 2018 now. 2018, the market goes down almost 20% on the S&P 500 on an intra-week basis. I believe it was a 59 trading days that it did so. Pretty quick drop here. So from top to bottom, we'll call it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks. 12 weeks is all. So very, very short period of time. Big correction. And then we get a positive crossover, 34-week moving average. And then the 13-week moving average crosses below the 34-week again, but really, really, really late. And the reason for that is because this was COVID. COVID was the fastest drop in the market in U.S. history. As you can see here from top to bottom, we've got 1, 2, 3, 4, 5 weeks. That's it. In fact, if you go intraday, it's 22 days. The market was down about 34% intraday, I believe is the number. And so when you look at all these numbers, you can see this wouldn't have helped you. In other words, just like the Black Monday situation where it would not have helped save you, using just an indicator like this isn't going to help you during a COVID either. So it's one of those things where you have to wonder when you're sitting here at the edge of the chart, is it going to get worse from here or is it going to get better? And inevitably what ended up happening was things got better during COVID, which didn't make any sense at all at the time, and it still doesn't make any sense. But it really doesn't matter because the market's going to do what it's going to do. It doesn't care what we think. What we have to do is we have to watch the market. We have to follow it, and we have to follow the trend. And as the saying goes, the trend is your friend until the end, or the trend is your friend until it ends. And here we are in today's market, the S&P 500, 13-week moving average crossing below the 34-week here in early 2022. Even though the market actually peaked, if you look at stocks inside the stock market, biotech, internet, social media stocks, all tons and tons of these stocks had peaked in February of 2021 and were already going down. And then the indices, they peaked here in late 2021, early 22. We get the crossover here in March, we'll call it, of 2022. And then we just got a positive crossover here at the just a few months ago, actually. And so far, we're seeing higher weekly closing prices above the February high, the February weekly closing high, which is good. That's positive evidence. And now we just need to clear these summer highs, the August highs. If we can clear those August highs, I'm going to start feeling really, really good about this market. But until then, we're all talking in probabilities. And what I mean by probabilities is that I'm feeling really good right now that the bottom we saw or the lows we saw in October, I think are probably going to be the lows for this market. I don't think we're probably going to see those lows again. Now, if this blue line right here, if the 13-week moving average crosses back below the 34-week moving average, if the market crosses back below 3,800 on the S&P and starts heading lower below these lows right here that we saw this year, then that's going to change my opinion. And obviously the probabilities then change. So whenever talking about the market, you have to be very, very careful not to allow yourself to think in terms of predictions. And worst of all, to say, well, if I think this is going to happen, or if here's what the probabilities are telling me, to allow yourself to think that, well, because the probabilities are telling me that that's what's going to happen, that's a certainty, and then to get married to that idea. You have to, as one of my mentors once told me, there's nothing wrong with being wrong. It's impossible to be right in the market all the time. So there's nothing wrong with being wrong. You just can't stay wrong. You have to be willing to change your opinion as the market changes. and and change your analysis as the probabilities change. So what we're seeing right now is a rising market of higher highs and higher lows amongst the backdrop of a 13-week moving average crossing back above its 34-week moving average on the S&P 500, and a market that's been down as much as 27.6% this past year. Just to summarize what some of the statistics we just looked at very quickly. Again, 1957, there was we saw a drop, but the first drop was only 14.5%, and the second was only 20.5%. 1960, we saw one, but the first drop was only 8.9, and the second was 13.6. So I wonder if it even counts. 1965, the first drop was only 9.6%, but the second was 22.3, so a little bit more significant. 1969, the first drop in the market was 10%, and the second was big, down 36%. And if you remember back from the chart, the crossover, the 13-week over the 34-week moving average crossover, would have saved you some pain. In 1990, the first drop was 11.3%, and the second was 20.4%. In 2001, the first drop was a huge during the dot-com bubble, 39%. Then, after the 13 over 34-week moving average positive crossover took place, barely, we saw another final drop of 34.7, almost 35%, before the market finally bottomed. 2015-16, the first drop was 12%. Then, again, we barely had a crossover before a final drop of 14.5%. But during that time period, we saw almost 2 full years of the market going down sideways, but down twice. And then 2018, 2020, we've got a first drop of 20% almost. Then the market goes to new all-time highs. Then COVID happens, and the market drops, 35% in 22 days. And that was obviously a really, really rough time. Now, if we look at the double dips and retests, so those were just the new lower lows. So the ones I just showed you are the times when the market experienced new lower lows after the first drop. So first drop, then a lower low. We're looking at double dips and retests. 1981, we had a drop of 17.1%, new all-time highs, and then a 27% drop, but still no lower low. In other words, those lows were not surpassed. 1994, the first drop was 9.7%, and then we saw another drop of 7.3%, but never saw a lower low, and we had all-time highs from there. 2010, a drop was 16.9%, and then 21.6% before a new all-time highs, but still never a lower low. And then the average drop. So when you look at the average first drop, this was really interesting to me. The average first drop in the market on the first crossover was 18.5%. If there was a second one, the second average drop was 23%. So if when you look at the two drops, the second one is typically bigger than the first one, but the first drop is only 18.5%. When you compare that to all the data we just looked at, there's only been one time since 1950 where the first drop was more than 20%, and the second drop ended up being a second leg down that was larger and a lower low and a much bigger number at 34.7%. And this was between 2000 and 2002 when we had the dot-com bubble, Y2K, we had a war in Afghanistan, we had the World Trade Center, a lot of crazy stuff going on U.S. soil, and a lot of rough things going on in the market at the time. When you compare all of that to today, we have a first drop of 27.6%, which far exceeds the average first drop. And by the way, it also exceeds the second biggest, the bigger drop, the second drop, when you look at the averages. So the question is, now what? And this is where I leave you to draw your own conclusions. But for me, when I look at this big drop of 27.6%, and I compare it to all the other drops we've seen in the market, whether it be double dips or not, is irrelevant to me. It's, in my opinion, that we probably have seen the bottom. I put 75% on it. I said I'm 75% sure that we've probably seen the bottom in October and the market heads higher from here. Could we have a recession? Yes. Do I care? No. If we have a recession, I think it'll be pretty shallow. I think the Fed's probably done raising rates here after this month. And from that point on, I also think that there might even be some opportunity in bonds for the first time in almost 2 years where, we've been largely avoiding the bond market altogether. So I think I've said enough today. So thank you so much for joining us. Feel free to share this episode with your friends and family if you'd like to discuss your personal situation further. Easy for me to say. Remember that you never have to be a client to ask a question, so please feel free to use us as a sounding board. As mentioned earlier, if you'd like to set up an intro call to discuss your financial situation, or if you'd like a second opinion on your retirement plan, head over to our website at libertaswealth.com. click on that button that pops up in the bottom right-hand corner that says, click here to get started, answer a few questions, submit it, and then we'll reach out to you to set up an intro call to get on the phone with me. Be sure to subscribe to this on this podcast on iTunes, YouTube, and Spotify. And remember, you can sign up at our website, by the way, at libertaswealth.com to not only get these updates, but you'll also get access to the screencast videos and articles that we send to our clients delivered as soon as they're released. So again, not just podcasts, but also our screencasts, articles, and other materials. Feel free to follow us again on Facebook at facebook.com/Libertas Wealth. I'm also on Twitter at Adam Koos, as well as Instagram at Adam D. Koos. And as I always say, there's thousands and thousands of podcasts out there. You chose to give ours a listen today, so thank you so much for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.